And welcome to my daily chorus. I'm Bernard Hickey for the Kaka. This is a podcast and video that I do daily for my Substack called the Kaka, which is all about Aotearoa's political economy around housing, climate, and poverty. Today, I wanted to focus on two things. Firstly, around jobs, and secondly, around transport. Tomorrow, Wednesday, there is going to be the June quarter jobs numbers come out from Stats NZ. And economists are expecting unemployment to rise from around 5.1% in the March quarter to about 5.3% in the June quarter. And employment is expected to fall around 0.1, 0.2%. That's because the leading indicators of jobs show continued job losses, very low job ads, and the indicators from the services and manufacturing sector show that there was a renewed contraction in the June quarter. And the Reserve Bank is currently forecasting that, and it's now cast forecast that activity, GDP, actually contracted 0.3% in the June quarter. So this is at odds with the government's argument that it is all about going for growth, 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 and that its strategy of cutting interest rates to revive the economy will work. And the reason why it's not working this time around is that the government itself is cutting back on spending growth, particularly in construction of houses, infrastructure, hospitals, schools, and the likes. This was something they did very early in 2024, all about reducing the government's borrowing and deficits with the idea that this would reduce interest rates. Unfortunately, it's having an unintended consequence. There's a sort of a reverse effect, a sort of a loop of less spending begets less spending, begets fewer jobs, begets less spending, begets less tax, you get the picture. It's a type of doom loop. And it's fairly standard macroeconomics 101. And it only works, this strategy, when you have households or the business sector effectively gearing up, taking on more debt to offset the lowering of spending and the lowering of debt by the government. And this time around, that's not happening. Firstly, businesses can feel that consumers aren't spending and they aren't in the habit of investing heavily in their own businesses. And consumers, the ones who are spending, are feeling very stretched because household living costs have been rising faster than wages, and they now expect that to continue. So the risk here for the government is that unemployment continues to rise. That's at odds with what Treasury and the Reserve Bank are forecasting, but there's the risk there that the economy goes into a double-dip recession, unemployment continues to rise, jobs keep falling, and the government goes into the last year of a 3-year election cycle with an economy really struggling to get going. So it's worth knowing, therefore, what's going to happen with jobs and unemployment. Well, yesterday we got a note out from Miles Workman, the senior economist at ANZ, looking at the idea of jobs hoarding. So this is the idea, and there was a lot of this seen, particularly in 2020 and 2021 during COVID, when a business, particularly a larger business, would decide to keep workers on rather than laying them off, even though there may not be work for them to do now or in the future. And Miles has used a couple of tools to try and estimate how many workers might be hoarded. And he's used a thing called Okun's law. Don't ask me to explain it here in this podcast, but just Google it. And it's a way of measuring what the true unemployment rate would be if businesses did their thing in a very strict way and weren't hoarding workers. And according to that analysis from Miles, in a note he put out yesterday, in which I've linked to in the email newsletter, that gap has opened up to about 0.5 percentage points. And that would mean if employers decide, okay, I can't wait around any longer for this recovery that Christopher Luxon has been talking about forever but hasn't arrived, I just need to move on and lay off these workers who've been hoarded, that could potentially increase the unemployment rate towards 6%. And remember, it's likely to be 5.3% at the end of the June quarter. We'll find out on Wednesday. And it's not just the Oakens law. Miles has had a look at the ANZ Business Outlook survey, which asked the question, what is your limiting factor in your growth? Is it workers? And it's clear that, over time, there has been a correlation between the unemployment rate and this measure of what businesses are saying about their labour force. And again, this shows, as you can see at the end of that chart there, the blue line is the unemployment rate. The red line is what would normally happen if people were laying off workers and weren't hoarding. You can see there during COVID, particularly with the job subsidies, that there was worker hoarding, and jolly good thing too. However, again, we are seeing this number for how many people should be laid off, if you like, around about half a percentage point higher. So getting up towards 6%. Now, if that is the case, if the employers say, okay, that's enough, I'm capitulating, I'm giving up, I'm going to let these people go, what would happen to demand in the economy? What would happen to inflation in the economy? What would the Reserve Bank do about it? Well, Miles is suggesting that using this Oaken-based unemployment rate forecast here, you'd need to see the Reserve Bank look to cut interest rates below 2.5% to avoid the unemployment rate affecting inflation in a way that non-tradable inflation falls below 1%. Now, normally non-tradable inflation is somewhere over 3%. And if we see unemployment rise over 6%, Miles is saying, all other things being equal, you would see the Reserve Bank have to react by cutting the official cash rate to below 2.5%. Remember, it's 3.25%. Now we're expecting another rate cut next month and possibly another 2 more, say economists, although markets aren't so sure about that. That would take the official cash rate down to 2.5%. Now that's seen by the Reserve Bank as right at the bottom of their band of estimates of what they call neutral. So there's this idea that the official cash rate has a neutral. Now it's impossible to measure in real time, but it's there, says the Reserve Bank. And obviously, if you're in neutral, you're not stimulating or slowing down the economy. And so the Reserve Bank is cutting interest rates from being stimulatory to being not stimulatory. Now, if it needs to stimulate, to go, faster than neutral, if you like, and put the foot down, it would need to cut the official cash rate below 2.5%. So once you're getting down to sort of 1.5% even, that in theory would get the economy going again. It would certainly get the housing market going again. But here we have again a trade-off. You increase unemployment to get interest rates down to push up house prices. It's not a way to run an economy, in my view. Not that I'm suggesting ANZ or Miles is suggesting it. He's just trying to work out what is the level of hoarded workers and whether or not they might be laid off. Now, the other thing I think is worthy to note today is a scoop from Oliver Lewis from BusinessDesk. It's behind a paywall. Unfortunately, I don't have any gift links left, but he's reporting that NZTA is saying that the Ōtaki to north of LevinRoad of National Significance, so one of these big 4-lane motorways that we're all familiar with, the cost of that has now blown out, estimated cost, because it's still being built, to $2.1 billion. Now, right back in 2020, when there was first discussions about this in earnest, actually under the previous government, the Labor government, the cost was estimated at $817 million. So it's more than doubled in cost. Now, the cost estimated in May this year was 1.7. It was 1.5 in 2021. So the cost is really blowing out here. And when you look at the cost per kilometre, so how expensive is it compared to other things we've done, you can see, according to this NZIER analysis, of the last 8 roads of national significance, and you can see the table there. I've included it in the email newsletter. So all the ones we're familiar with: Transmission Gully, Puhoi to Warkworth, the Hamilton and Long Swamp sections, the Huntley section and the Rangariri section of the Waikato Expressway, and of course the existing parts of the Kapiti Expressway, which this one would connect up to. And the average cost in 2023 dollars of those motorways was, according to NZIER, around $39 million. So 2.1 billion for 24 kilometres of this RONS would be $87.5 million per kilometre. That's more than double the average cost of the previous 8 RONS. And remember, the $1.7 billion estimate, which is now out of date, that implied a benefit to cost ratio of $1.20 for every $1 spent. Now, usually you don't go anywhere near a project like this unless you've got, BCRs, benefit to cost ratios of 2, 3, 4, 5 to 1. This estimate after this cost blowout means this road is going to be twice as expensive as the average of the previous 8 roads, and its benefit to cost ratio will be well under 1, i.e. we are pissing money against a concrete wall by building this thing. Now, it's going to go ahead, but it again just calls into question the government's arguments that it's doing things for the economy, that it's all about being rigorous with its business cases, and this is all about improving the economy. Well, actually, this is a bad business decision, and it's going to cost taxpayers in general a lot of money. So we're essentially paying $2.1 billion for a 4-lane motorway, which will make those people who have property on the edges of the motorway and at the end of the motorway richer, because it increases the land values around that, but they're not going to pay for that. There may be a toll. Let's see if that actually happens. Whenever a motorway is built and then suddenly someone turns up to try and toll it, it's amazing how people complain and it doesn't actually happen. We certainly saw that with the big motorway that's gone across the Tararuas not far from this one. I'm Ben Ōtaki. That was today's daily chorus for Tuesday, August the 5th for the Kaka. Ka kite anō.